John,
Man,
do you know what? It's coming up for Christmas. This is exciting. Let's talk about chocolate. Have you got your advent calendars for your kids yet?
yes, but we don't do chocolate advent calendars. We do religious ones. Thank you very much.
You are so middle class.
I know. I'm trying my best.
Okay, so we did that for ages. Absolutely, no chocolate, full on religion. And then one day I thought, what's the matter with you? The kids prefer chocolate to God. Get them chocolate advent calendars. But to make it not too awful, I started buying them their chocolate advent calendars in Hotel Chocolat. Right?
And you call me middle class.
It's all gone very well so far, except for 1 year when I bought vegan ones by mistake, not so good. And another year when I bought the kids ones that I thought was milk chocolate, in fact, were a little bit too dark and they didn't like that either. But otherwise, I'm very impressed by the chocolate. It's all gone very well. It's almost like not buying them chocolate advent calendars because they're quite posh advent calendars. It's kind of okay. But now I'm getting worried. Hotel Chocolat has been taken over by Mars, American company, and it's one of the many UK small and mid-cap companies that is being taken off the UK market by foreign investors at a massive premium to the trading share price. Now, John, we have been telling our listeners and our readers for, I accept, far too long that they've got to get out there and buy this cheap stuff before somebody else does. And it's now happening. Somebody else is buying up our cheap companies, right?
Yeah, and I mean, to be fair, this isn't the first one. It was just kind of particularly eye-catching, partly because it's Hotel Chocolat, so a lot of people know it, and also because it was one of the two companies that got taken out that day. And to be fair, the other one was a pub company that got bought by another pub company. But the point is, they both went for big premiums. I mean, the Hotel Chocolat particularly. Mars clearly just thought, no, let's get this over and done with. We just want it. So they paid something like 170% over the prevailing share price. I mean, that was partly because Hotel Chocolat, for all that, whatever you think of the product quality, they have had some trouble recently.
It's delicious. I love it.
They had a couple of profit warnings.
And just in case, those Christmas selection boxes, just keep them coming, everybody.
See, now you know what to get, the podcast for Christmas. But yeah, so they, the point is that somebody sees the value in these companies, and if us as retail investors don't see that, or more pointedly, global fund managers don't see that, well, tough. People are just going to pick the low hanging fruit, and as a retail investor, you might as well benefit from that. Is my view.
Well, you might as well. I mean, another journalist, one who we approve of, said the other day that this is a once-in-a-generation opportunity for UK investors, and they don't come along very often. And when I was talking to him on Twitter, and I tweeted, if you missed, as many of us did, 2020, and you missed 2009, the market is just looking at you saying, look, there's a pile of cheap stuff out here. Other people are going to buy it if you don't. Why don't you want this cheap stuff? What are you frightened of here? Can't still be frightened of Brexit. This is silly. Get over it.
Yeah, and it's interesting because you said this the last time, but it's not, these opportunities don't usually last. And often the reason that people don't take advantage of them at the time is because at the time they're very scary. So, 2008 or COVID or whatever. But this time it's lasted for ages. The backdrop is arguably better than at any point. If you were scared about Brexit in 2016, and if Liz Truss freaked you a year ago, even though it wasn't exactly her, but let's skip over that for the moment, you cannot deny that, the political outlook at the moment is much less chaotic than at any point that it's been since Brexit. So even if that was the thing that was bothering you, it doesn't make sense that it's still bothering you now.
Now the place to go, right? I don't want to go on about this, but the place to go has got to be investment trusts, right? I know you've written about this recently, about the investment trust. We've talked about this before, and we're going to keep talking about it until it's not there anymore. These huge discounts on investment trusts. So you've got this double discount for exceptionally cheap companies inside some of the small and mid-cap focused investment trusts. So you've got the cheap companies and then you've got the discount on top of it. It really looks like something that all retail investors should at the very least be looking at, right? And you've written about some of the bigger discounts and more interesting trusts out there. That's in John's Money Distilled newsletter, unless you want to mention any of them now, John.
Well, it's more, I think, You can look at the sector, and honestly, you can go to the Association of Investment Companies website yourself and have a look as well. and explore these things. It's a really good website. Most of these things are cheap. The main thing I would kind of point out is that you can look at the discounts, but one thing to be aware of is that certainly in the smaller cap side, a lot of the investment trusts are basically too small to be invested in, and some of them are either winding up, or you look at them and the bid offer spread is insane. There's a couple of ones I kind of looked at and it's like, oh, that looks interesting. Then you realise that you're losing 6% as soon as you buy it. So be aware of that if you're kind of investing in kind of smaller trusts. So there's a lot of stuff out there, so have a delve about.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. This week, we bring you a conversation with Edward Chancellor. He's a financial historian, he's a journalist, he's an investment strategist, and we have been following his work for years. His most recent book is The Price of Time, The Real Story of Interest. So I started the conversation with Ed on his area of expertise, interest rates. Now, Ed, one of the things that you are an absolute expert on, and it turns out almost nobody is, although one would wish that there were more experts on this, is interest rates. And here we find ourselves today in a fairly extraordinary situation where it looks like our central banks don't necessarily understand how interest rates and inflation works. And we have rates having gone up at the most tremendous speed as everyone focuses purely on inflation and nothing else, bringing down inflation at the expense of all else. And it feels like we might be missing some other things that are happening in the economy as a result of this phenomenally fast rate in interest rates. And I'm wondering if at the same time, right now, as other people are beginning to think, oh, everything's fine, inflation is coming down, soft landing ahead, you might be feeling a little more nervous.
Yeah, I am.
Yeah, I thought you might be. Let's talk about why.
Merryn, as you know, the context for this is that we've just come off this period of the lowest interest rates in history. And when we last spoke, we talked about the new book I had out, The Price of Time, which was a history of interest, not really of interest rates per se, but of what interest was when it came about and what it did. And we've got 5 millennia of interest rate history, and so we've got a lot to draw on. But if we think about the last 15 years, we went to this very low period of interest rates, zero rates, policy rates, and negative rates in Europe and Japan. And the question is, what did those zero and negative rates do? And the argument in the book was I was saying, well, actually, the economists and the policymakers don't really understand interest. They see it purely as a lever to control inflation. And we should talk about that lever a bit later on, because it is something to think about. But in the book, I draw attention to these other functions of interest, which is, the capitalization rate for valuing assets, the hurdle rate for making investments, the price of risk, a price put upon risk or a price put upon leverage, an inducement to save. And these other functions of interest were ignored by the central banks. And I think that they led to a huge buildup of risk in the financial system. And actually, because of the impact on the allocation of capital, to a misallocation of capital. And I think that will take people who read my book said, oh, Chancellor wants higher interest rates. Well, I mean, I wasn't exactly saying that. I was saying interest rates should never be this low, or should never have gotten this low. And once you get that low, you're in a position of what the economists would call disequilibrium. Or if you want to make it slightly even more complex, you could say we were in a state of intertemporal disequilibrium. In other words,
you're going to have to explain that.
So Merryn, the interest is the price of time. All financial activities take place over time. To be in balance, your current borrowing and saving and investment has to be in line somehow or other with what your future spending is going to be. If you distort the rate of interest, you distort the price of time, and therefore the present and the future become out of whack. Now, one way, I think it's very easy to see this, and you were talking to Jeremy Grantham the other day, my former boss. I mean, as Jeremy would say, if you push up valuations, you're going to get lower returns in future. It's just straightforward. And the point is, we pushed up valuations without taking on board that the overall returns from our investments were going to come down, and therefore we were not going to earn as much as we anticipated in the future. Now, that problem has been partly taken away by the rise in interest rates, which brought asset prices, bond prices, and equity prices down last year. But I think that is still an ongoing process. And there are all these other areas, allocation of, the misallocation of capital, the so-called zombie companies created by the low rates that have yet to sort of feed through. So
Can I interrupt you briefly just to ask you where you think these main misallocations of capital have taken place? And we talk about those zombie companies. Are there particular areas where capital has been misallocated and that's going to cause us specific problems in the future?
Well, so if you remember, I in the chapter I write on the impact of interest on capital allocation, I argue that interest really serves the function of to propel Schumpeter's creative destruction, the sort of taking resources from low return uses to high return uses. And I think that that the very low interest rates were a form of loan forbearance, and therefore capital was trapped in activities with low returns. And that, from what one sees, is a fairly global phenomenon. You see it particularly in Europe, you see it in the United States, and you see it actually in China too. As for the sectors, I think that's really quite across the board, the type of sectors in which capital is trapped. You can think of any area in which businesses that are not, returning and earning enough profit to even pay their low interest costs. They might be in retail, they might be in manufacturing, they might now, particularly be in commercial real estate.
Okay, so you wouldn't pick particularly on say a residential property or renewable energy or anything like that.
Well, renewable energy, that is. I mean, I'm glad you picked that up because the renewable energy boom, particularly in these wind farms and solar farms, that was a beneficiary of the ultra low interest rates because the capital costs of these great wind turbines was all up front, and they were rendered viable by the very low interest rates. And as you've seen, the Ørsted, one of the big wind farm operators, has run into trouble. Its stock is down 75%. I think that's, to a large extent, a function of the very low interest rates. So when the speed of the energy transition was accelerated by the very low interest rates, and I think as interest rates rise, that the whole thing slows down. But actually, I want to get on because there's another aspect of the misallocation of capital, which is and I suppose you could include alternative energy in this, in venture capital, in projects that have very distant returns, whose profits lie in the future. So we saw this massive capital flow into Silicon Valley and the great sort of unicorn phenomenon. And some of the unicorns, earned their faith, such as Facebook. But the others were the likes of WeWork, which went bust in the last couple of weeks. WeWork, the office rental company that sort of dressed itself up as a sort of tech, renting office space over an app. A lot of the venture capital businesses have run into trouble. And what I understand now is that VC investments are now passing hands between partners at massive discounts to their official price. So I think it's, in a way, there's a sort of barbell. You have the zombies if you will, sort of old-fashioned businesses but unprofitable, where capital is locked in by the low rates. And then you have the sort of the high-tech venture capital stuff, which also is marked by a tremendous misallocation of capital.
Do you have a sense of what kind of discount some of these non-profit-making VC assets are trading at to, say, their last round?
I've heard of discounts of sort of 40% thereabouts. And we know that, huge capital inflows into venture capital happened in, up until 21, and that those capital flows have dried up. So I think the returns, thrown the fact that the low interest rates boost valuations, I think the returns of venture capital up to 2021 over the recent years have been frankly exaggerated by the low interest rates, and that will reset. So I would expect quite a long shakeout in that area, and people, because it's not listed, takes longer, as you know, for private equity and venture capital to mark their investments to a proper market price, but that will happen.
This rather suggests, Edward, that you haven't fallen for the story that we've heard so much over the last decade or so, that private equity is simply better at managing companies than ordinary listed company management, and they can do things in different ways, and they're 100% ownership as opposed to small ownership means that they can really make things work better, and that explains their superior performance, not in any way the very low interest rates that have allowed them to have capital for practically free. And you seem to be disagreeing with that.
Private equity is different from venture capital.
From venture capital, yes, of course.
And private equity is, to my mind, really largely a matter of financial engineering. It works well when interest rates are below the return on capital, because you can lever up and squeeze out profit. Now, one definition of interest is the price of leverage. So it comes as no surprise that the private equity business starts in 1982 with the former US Treasury Secretary, Bill Simon, taking over a leverage buyout of a greetings card business called Gibson Greetings. And that is tremendously successful. And after that, you get the arrival of sort of KKR and Blackstone and so on. And these people are really more investment bankers than investors. And they know about structuring the balance sheet to squeeze out, to leverage some profit. And you're going to get a profit, as I say, if your cost of borrowing is below your return on capital. And that worked very well. And I was covering the private equity boom going into the financial crisis. And I thought there was going to be a tremendous shakeout then. And it didn't really happen because the very low interest rates after the global financial crisis, which in effect allowed the private equity companies that had been hugely irresponsible up to 2007, they basically were able to refinance their portfolio companies after 2008 at very low rates. And then you got big bull markets. You got an exit for their businesses. But I think the private equity has been in trouble. You probably heard about it. There are a lot up to 2021. Private equity firms in the United States I think they were doing deals on 9 times EBITDA, earnings before interest, tax, and depreciation and amortization. And they were putting they said they were doing highest valuation deals with the largest amount of debt. And a few of them, I think the only one I know of that actually stood back was Apollo, the buyout private equity company that actually just pulled back when deals were very highly priced and when too much debt was going on to companies. But I think the rest of the industry carried on going over the cliff and are having trouble now. Now, take, for instance, Blackstone. They have something which you probably read about, the Blackstone Real Estate Investment Trust, BRID. And there, again, the market price of that has been trading below the declared asset price. And there was an offer to buy out private investors in that at a 40% discount to the net asset value. So again, a similar level of discount that you're seeing in venture capital space.
It sounds to me As if those critics of yours, after you published your book, who said, oh, Edward wants higher interest rates, were rather right in that while you may not have actively wanted there to be dislocations in the economy as a result of rates rising, it certainly will bring us back to a position where capital will be correctly allocated, and where the sectors and companies where it has been incorrectly allocated will disappear. So it really can only be seen as a good thing. And we used to say,
No,
or I used to, yeah, carry on.
Well, look, alcoholics shouldn't be drinking a bottle of whiskey a day, but it turns out that if you take a bottle of whiskey away from an alcoholic, you can actually kill them. I mean, in other words, coming off an addiction is a dangerous and fraught process. And yes, it would be ideal not to be an alcoholic. It'd be ideal not to have, live in a world in where assets are overvalued, capital is misallocated, people are saving too little, and future returns on investments are going to disappoint. But that's the world we live in. And the question is, how do you get out of that world? And I don't think people understand that this process is extremely fraught, and will also take a long time. We could say the progress to low interest rates, was almost a 25-year process. You could say that perhaps long-term capital management blow up in 98, the hedge fund, when the Fed responded by lowering rates, and then we got dot-com bubble, and then they lowered the interest rates further, and we got a real estate bubble, and they lowered the interest rates ever further. So we've been in this 25-year period of rates coming down, and that's in the context of a 40-year period of a bull market in bonds of ever lower long-term interest rates. So I don't think this thing just changes overnight. I think that the impact of the higher interest rates takes a while to feed through. And you can see this, for instance, in people, take housing, for instance. In this country, a lot of mortgages are on 2 to 3 year fixes, and it takes a while for those fixes to come off onto floating rates. In the US, it takes even longer because people borrow on with long dated mortgages. So that takes really a long time for the impact of higher interest rates to be through. It's likewise the case for corporate borrowing. In the era of very low interest rates, there was a great inducement, as you know, for companies to take on more debt, which they could either use to buy back their shares or to buy other companies. And a lot of that debt would be termed out, so they wouldn't have to. As interest rates rise in the short term, it doesn't affect their cash flow. But that's only a relatively temporary basis. I was talking the other day to a European telecoms company that had, I think, around sort of 50 billion euros of debt, and about I think it had $1 billion euros of free cash flow, but its loans were termed out for 3 or 4 years. So it wasn't going to be an immediate problem. But at the current interest rates, that business was going to run into extreme problems if it was going to have to refinance at the market rates of interest rates that we've seen this year.
And then on the other hand, you have some companies, and even some of these big technology companies, that have huge amounts of cash on their balance sheet, and with interest rates knocking around 4 or 5, whatever percent, that's a rather nice little boost for them. Goes both ways.
Did you see a chart that Albert Edwards at SocGen showed a couple of months ago, where he showed a chart saying that actually the net interest income of US corporations had actually risen year to date, and as a result of the cash, earning more. I think the trouble with that type of analysis is that Apple may have a lot of cash, but someone else has a lot of debt. So if one looks at these things in aggregate, everything might look better than it actually is. If you remember, Merryn, before the global credit crisis, everyone said credit doesn't matter. One man's debt is another person's asset. Well, it just didn't really work out like that because one person's asset was not the person who was in debt couldn't actually afford to pay the debt, and therefore that wasn't particularly good for the other person's asset. So you have to be slightly careful with this aggregate analysis.
Fair enough. So take all that together. What do you see from here? A sort of slow burn misery for a decade as we work our way out of this, or a crisis of some kind?
I don't want to sort of cop out, but one thing I would say is that the crises that we have been experiencing over the last 25 years are becoming analytically more complex. For instance, again, go back to the dot-com bust was, pretty simple. You really had to be dumb not to understand how that was coming and how to analyze it. I think the credit crisis, the global financial crisis, was much more complicated with the structured credit and problems in subprime and collateralized debt obligations. I think the problem that we have today is not so much complex financial structures, but the fact that the low interest rates that prevailed for so long had such wide effects. I cite in the book the Harvard economist Jeremy Stein, who was briefly a Fed governor. He says that interest rates get into all the cracks. And I like that comment because it should be telling you that the problems created by the very low interest rates have got into a whole load of cracks, some of which will be pretty obvious. I mean, so for instance, take, for instance, just the speculative boom in SPACs and so on. There was an amusing comment by the SPAC king, Chamath, if you remember him. And he said the other day, the trouble with rising interest rates is it renders your business valueless. Well, okay, if you have an inherently valueless business, yes, the rising interest rates expose it. So we've seen we saw the blow off in hyper speculative stocks. Okay, pretty easy, pretty obvious. But then, for instance, we knew that the bond prices were elevated, that yields were negative. And it wasn't a tremendous surprise that long-dated bonds suffered a lot over the last couple of years. However, I didn't know, and I don't know if you knew in advance, that, for instance, the UK pension funds had leveraged up their holdings of 50-year UK index-linked bonds at negative yields, and they'd levered them up 5-6 times. Now, that blew up in September of last year, but it wasn't, what I thought interesting about that was we knew there was a pension problem caused by the ultra-low interest rates and how this inflated their liabilities and how they had to hedge it. I wasn't quite sure what they'd done about it until after the fact. So I wasn't anticipating such a blowout. And in fact, actually, a lot of, as you and I know, some of the investors who were caught on the wrong side of that trade. So it wasn't anticipated even by quite smart people. The question is, so where we are going forward, some obvious problem. Obviously, one's reading about problems with commercial real estate, and that would make when people working from home and so on, you can see that commercial real estate is going to be in trouble. I don't know, take, for instance, the problems at the regional banks earlier this year with Silicon Valley Bank going down and a couple of other big banks going down. Now, you'd have thought that, one's taught that higher interest rates are good for banks because they gives them a steeper yield curve so that they borrow short and lend long and they make money. In fact, actually, in this case, the banks had borrowed short and then they, from their depositors, and then had bought medium-term debt and had capital losses. So there was a problem that one wasn't necessarily immediately anticipating. And then, for instance, with the banking system, the banks, as you know, around the world, sitting on massive excess reserves. They have massive deposits with the central banks, having served as the conduit for selling all those bonds during quantitative easing. Now, I don't quite know what's going to happen to those excess reserves. I don't think that taxpayers at the moment are paying interest on their reserves. whether that actually leads to problems for the banks, whether governments around the world become reluctant to pay it. So again, so the question mark would hold, to my mind, is over the entire banking system. Then we've got China, the problems with real estate in China, pretty obvious with China's real estate. And I've been banging on about China's real estate bubble for at least, 13 years. And it was a bubble that went on and on and on and got bigger and bigger and bigger. And it's been blowing off for the last couple of years. And we've seen, Evergrande go down and then Country Garden, the biggest developers. But we don't really know the long-term outcome of the higher interest rates and what's going to happen to China's real estate and China's economy and financial system. I mean, one outcome that I've thought possible was that China's currency would sort of blow at some stage, but it or crack, let's say that. But I mean, that's one potential outcome. But I think there will be, there definitely be problems coming from China over the coming years, I would have thought. The Chinese are very good, or have been very good, at hiding debts within the system. But I don't think that process, it can go on forever. So then you've got residential real estate. That's taking the UK, for instance, it's taking a while to come down. The benign situation there is for, the nominal price to house prices to remain more or less level, but with inflation eroding the value. But, there's also potential for a crack. So I'd say that, there are a whole load of areas that one has to analytically worry about.
Okay, I'm going to put that down as an I don't know, but not so scary stuff out there, as an answer to the original question. Yeah? Now let's go. Is that fair? No, you're worried that's not fair.
That's fair.
As a summary, that's fair.
I'm saying the problem is too complex for any individual analyst to get their head around. It's a global problem, and the low interest rates have got into all the cracks, and those problems, because asset prices take a while to turn, particularly in private equity and venture capital, and because interest rates, people who borrowed for fixed for a short time, that the impact of the interest rates isn't felt immediately either for home buyers or for corporations, it's going to take a while to feed through.
Okay. Edward, right back at the beginning, you said you wanted to come back to interest rates as a lever to control inflation. You had something you wanted to say on that.
Yes, so it's actually something, it's something I didn't actually write much about in the book. I think because it's the one area that the central banks seem to understand about interest, that you can use interest to control inflation by putting up the interest rate. And I'm actually coming to the view that of the various functions of interest, that actually using the interest rate as a lever to control inflation is the least reliable of the functions of interest. It's pretty obvious. If you take down the discount rate, you're going to have higher valuations. It's just sort of pretty obvious. Now, the interest is a cost of doing business. And if you push up the interest rate, you actually push up people's cost of doing business. And for instance, if you're a worker and you've got a mortgage and your mortgage costs go up, then you actually need a pay rise in order to pay your higher mortgage costs. So in that sense, actually, the rising interest rates has perversely an inflationary effect. And you see this, I think you see this where, landlords putting up rents having faced higher mortgage payments, or farmers who heavily leverage having to charge more for their food and so on. Then there is this, if you want to get more technical and theoretical, there's a guy at Stanford called, have you come across him, called John Cochrane, who has something what he calls the fiscal theory of the price level. Have you come across
Lord.
that, Merryn?
Not yet, but now I'm going to have to go and look it up and put it in the show notes.
I mean, it's a
Fiscal
really
theory of the price cycle. Sorry, listeners, this is what we have to do.
Yeah, Cochrane. It's a really, he's written 800-page book on the subject, of which most of it is equations, so it's sort of over my head. However, I think I understand the basic insight, which is this: is that in a world with modern world of fiat currencies and so on, governments do not go bust, and instead they inflate away their debt. Okay, you accept that? If you have lower interest rates, the debt becomes more sustainable, and therefore you'll have less fiscal incentive to inflate away your debt. However, when you have higher interest rates, then the debt is less sustainable. Therefore, it's technically more insolvent. And as it becomes closer to the insolvency, you get more inflation to pay it off. And that, I think that makes sense. The other thing that's quite interesting is if you have, although it's true that lower interest rates made the debt more sustainable, of course, the politicians couldn't resist the impulse to take on more debt. So you had, particularly during the sort of COVID period, you had this massive increase in government debt, induced by the very low interest rates. I think you and I spoke, 3 years ago about the whole lockdown thing. And my view was that lockdown simply wouldn't have happened had there not been such cheap financing of government debt. At the time, for instance, in the UK, the Bank of England was buying up, in effect, all of the bonds that the British government were issuing and charging 15 basis points for it. So,
without that, all this business of lockdowns and furlough and help to buy, help to eat, whatever they were called, eat out to help out, etc., none of that would have been possible without super low interest rates, would it?
I mean, no, it wouldn't have been done because people would have thought twice. The trouble back then is there was no thinking twice about what they were doing. But where are we now? I saw some data that the cost of government debt financing in the developed world has almost doubled in the last year. I think the American cost of debt servicing is running at about 15% of expenditures. British debt is, so you can see that the governments themselves, even if we didn't have any of these other concerns, we can see that the governments are going to have huge problems financing their debts, having splurged so much. And that gives them an incentive to keep interest rates below where they ought to be in order to control inflation. In other words, for all this talk of getting inflation down, there isn't at some higher level a strong incentive to do so. There's a much stronger, I'm sure you are too, I'm in the Russell Napier camp of financial repression, that interest rates will be below the cost of the level of inflation and the debt will be burnt off that way. And if financial repression, it can be quite, in theory, it could be quite smooth. And you and I know Russell. Russell thinks that it's very bullish for equities, and it probably is. This keeping in interest below the inflation, it probably helps it. Probably does help equities. I'm just concerned that just moving nominal rates, even if they're negative in real terms, off very low levels, will cause a few more hiccups than people expect.
Yeah. Although we do now, right now, we're in a very unusual period in the UK where the interest rate is actually above the rate of inflation. You stick money in a deposit account today and you can, for a very short period only, actually make a real return.
Yep, but that,
Take what you can get when you can get it. And right now you can have a real return, although possibly not after tax.
Merryn, the IMF put out a paper on historical experiences of inflation going back 60 years. And one of the points they make there, that inflation tends to remain persistent in countries that they describe as having premature celebrations. The premature celebration is when you think you've got inflation under control and you haven't quite got it under control, so it bounces back. And that's really the experience of the 70s, where a lot of premature, I think we had 3 inflation cycles. If you go from the late 60s, you said late 60s, mid 70s, and then late 70s, these 3 inflation peaks. And in between, you get these premature celebrations. So from what we've talked about already, you can see there's huge interest in keeping interest rates low. So they will leap at any excuse to cut rates. And therefore, if the past was any guide, it wouldn't be entirely surprising if inflation would bounce back.
Yeah. And that we can say, going back to Russell Napier, and this is very bullish for equities, might give us some positive news in that we may see a return to making good returns in the equity markets, even though it might not be fully justified by valuations.
Well, when you're talking to Jeremy Grantham, as he says, the US market is very overvalued in aggregate. And therefore one would expect, for me, that I'm a bit surprised at how strong it's remained. And as Jeremy was saying, there's a bit of a sort of AI bubble this year that has kept up the big tech names. But I would expect the US to have disappointing returns or possibly no returns over the medium.
Although if we look at the US market, if we look at all markets, but in particular if we look at the US market on an equal weighted basis as opposed to a market cap weighted basis, so we do the indices differently, it doesn't look nearly as overvalued as it does if you do it on a market cap basis. Right, so if you effectively equal weight the astonishing performance of the big 7, it looks a little different.
I think so. I haven't been looking at it recently, but my old firm GMO, they will do forecasts for US value and this and that, and I think that you get much more attractive valuations outside the United States. I mean, you tout UK.
I tout UK and Japan, and you've been touting Japan recently. Tell us about that quickly.
So I've long been a Japan bull.
That's been me too. It's been a tough gig, hasn't it, being a long-time Japan bull? But we're finally getting our rewards, I think.
Yeah, I mean, actually, you saw the piece I wrote. In fact, since 2010, Japanese equities have returned 7.3% real. I mean, that's
not bad, is it?
more than the average long-term returns of the US stock market, and really a return of back to the returns that Japan used to deliver before the end of the bubble economy in 1990. So I think that some of the headwinds for Japan were high valuations and then this period of deflation and deleveraging that hurt Japanese margins and return on equity. And I think that was over 10 years ago. So that was our reason for being bullish 10, 12 years ago. And that's been more than vindicated, let's say. However, one of the problems, if you remember, of Japan, of investing in Japanese equities, is that there were all these companies that looked cheap. I mean, in particular, these so-called nets, the companies that market cap was below the cash and working capital. And these are the businesses that the sort of Ben Grahams of this world wanted to own. And then they would go along, they buy Japanese companies, nets, and find that you'd go to the company and say, look, you've got too much cash on your balance sheet, or you've got these divisions that are not earning any capital and not earning a return on capital, and they're not core to your business. Why don't you get rid of them? And the management would just look at them and tell them to go away. And now that is changing. And that's what I wrote about recently. And actually, I visited Japan a few times just over 10 years ago with a colleague of mine who was a Japan expert. And he was very against Western activism in Japan. He thought that that these Americans who arrived in Japan, took a stake in a company, and then banged their fist on the table were doing it all wrong. And the firms that did that in the early 2000s, there was one American company called Steel Partners, they were rebuffed and they had disappointing returns. But now my former colleague, Toby Rhodes, who has a sort of small cap Japan business, he says that now the situation completely changed. He, for instance, has been made or nominated to be an independent director of a company in which he has an investment. We've seen the beginning of hostile takeovers in Japan. You've seen the Tokyo Stock Exchange has told companies that whose market cap is below their book value, of which roughly half the companies listed in Tokyo are priced at below book. These companies have been told to come up with a plan to get their market cap above book. Now, the Ministry for Economy, Trade and Industry, METI, wants Japanese companies to consolidate. And in order to drive this consolidation, it wants shareholders to push companies to get rid of poorly performing divisions and to merge. So I think that, so obviously Japan, the market is not as cheap as it was when it was, almost a third of its current price 12 years ago. But now there's potential for unlocking value in Japan, for activism, and for proper true value investing, as you probably know, requires activism. That's what Ben Graham, who was the father of value investing, he was an activist investor. And I think that now activism is coming to Japan with the support of the authorities. That is a major change and gives a prospect for really decent returns from Japan going forward.
Excellent.
So your final question?
Are you ready? I have to ask this one, Edward, because are you ready? Of course you are. And you know the answer. I have to ask everybody this one, okay? If I were to make you give me all your money and lock it away for 10 years, and I told you that I could put it for you into either a deposit account in the UK, an interest-paying deposit account in the UK, gold, or Bitcoin, which would you choose?
You know the answer.
It's not a trick question. It's not a trick question.
I would say gold, because we've talked that we expect financial repression on deposits to hurt, and we think Bitcoin is a sort of bubble asset. And there's a reasonable chance if we get financial repression, you'll get a gold bubble, as we did in 79-80, in which case gold will be up at $10,000 an ounce, and one have done very well. But
I would love that, Edward. I've been a gold bug for so long. Wouldn't it be nice if suddenly we had a proper gold bubble and we'd be vindicated in our affection for gold? Edward, thank you so much. I think you've given all the answers that I really like. Buy Japan, buy gold. I mean, this is fantastic. Thank you so much. Thanks for listening to this week's Merryn Talks Money. We're off next week. We're back the week after. Catch our debrief on this week's conversation on the Merryn Talks Money after show in our normal feed, and it is free to everybody, as are all the after shows in our archive. You asked for these to be free, we've delivered. And if that makes you happy, go ahead and leave us a positive review. It helps people find the show. And of course, please do tell your friends about this podcast. This episode was hosted by me, Merryn Somerset Webb. It was produced by Sam Asadi, additional editing by Blake Maples. Special thanks to Edward Chancellor and, as ever, to John Stepek. Please be sure to sign up to John's daily newsletter, Money Distilled. The link is in the show notes.